So today I want to talk to you about matching loan terms in relation to the asset that's being purchased, and in particular this comes into play a lot when people are buying a business with unsecured funding or franchise funding. So, but we'll talk about some other assets as well. So obviously with home loans, you have a long-term, it's a long-term asset, so it's a long-term loan. Now, if we think about when we're financing a vehicle, the value of that vehicle depreciates quite quickly, and usually you're looking at a maximum sort of 5 to 7 year loan term because the value diminishes over that time period. And most lenders want to know that the client can repay the purchase of that vehicle over a 5-year period or 7-year period. So when you structure a car finance deal, you might find that funders will do something like 5 years with a 30% residual. So what does that mean? It means that you've got a $50,000 car, you finance it over 5 years, and at the end of the 5 years there's still 30% left, which is $15,000, and the client can then either pay that out, or they might go and buy a new car and trade in and hopefully get that value of $15,000, or they might roll over that term for say another 12 months and pay off the 15 grand over 12 months, depending if the financier wants to do that. So that's a really small example, or a basic example of matching an asset to its life and to its useful value. So when we come back to say a business purchase, if you can think about a business such as a restaurant, then if they only have a lease, for example, of say 5 years with no options to renew, what happens after that 5 years if the landlord says, oh well, I don't want you here anymore, I'm actually developing this property? Then there's no security of tenure for the lender. So in that case, if you've got any unsecured lending, if I go back to one of my old videos in relation to buying a business at $1 million and you've got 500,000 unsecured, then the bank will typically want that unsecured portion paid off within the term of the existing lease. Now many places will have a lease that says, well, we've got 3 years with 2 options to renew of 3 years and 3 years. In that case, there's a 9-year lease term, but most banks like ANZ, NAB, etc. will want a 7-year maximum on that unsecured funding. So they might say, well, we'll give you a 7-year loan as long as it's within the lease term of the 9 years I mentioned before. But if you've got a 5-year lease term with no renewal options, we want the money paid back in 5 years. Remember that restaurants, typically restaurant businesses are location specific. Now some are obviously on reputation, but if they're a suburban restaurant, many people know where it is, that's where they go. If that restaurant now has to move out of that suburb or find another place, it might take them a while to recover, and that's a risk for the bank. It's why they want their money paid back within the lease term. So other assets like commercial property, obviously they're over a longer term. Some banks will do up to 20, 25 years. The majors usually sit around 15 years. They want that asset paid off, and returns on commercial property certainly for investment are higher, and as a result they expect more cash flow in, and they want that debt paid down. So in relation to matching loan terms to assets, have a look at the asset, the value of the asset, the life of the asset. So as I said, motor vehicle and equipment, you want to be paid off over 5 to 7 years. Commercial property over sort of 15 to 20 years, it's a longer term asset. If you're looking at say debtors finance, so debtors need to be paid out within 30 to 60 days. Why? Because that's that's when they should be collected. In fact, the maximum term you'll find for debtor finance is 120 days. And most funders won't do anything. They won't give you any money if your invoices are older than 90 days, or when they reach 90 days they will do something called disapproval, which means we don't want to fund this anymore, you need to go collect it. So that's a good example actually of an asset, an invoice being matched against a term, which is maximum term 90 days, because they want that cash flow to keep churning. Something like a grader, for example, then you might find a large one like $1 million grader. Again, they still want it paid back in that 5 to 7 years. They lose a lot of value, or can do, lose a lot of value over that time period. But the good thing about structuring certain types of assets like graders and harvesters, and if you ever come across that opportunity, is that you don't have to do it as a straight line. So for example, we did a number of graders for the mining industry where our client was purchasing on day one. We funded the GST into the deal, And so we did a structure where we had 3 months of $0 payments, and in the fourth month they paid a large lump sum, which included their refund on the GST from the purchase. Hope that makes sense to you. So they didn't pay anything for 3 months, then they paid a very large lump sum, and then they had another 48 payments or whatever the term was to pay out the rest of the machine. So we structured it around their cash flow. Some other types of structured deals where you can do it around cash flow is things like seasonal income, like cane harvesters or farming equipment, where maybe they are harvesting for 6 months of the year and getting cash in, and for the other 6 months of the year there's not much money coming in. So you might do something where you've got 6 large payments and then either reduced payments or no payments for 6 months. Again, you're having a look at the cash flow and the life of the asset, and you're structuring the deal to suit what the asset is, rather than just giving them a straight 7-year loan. And you can definitely talk to bankers about that if you've got a big deal like that and it's got seasonal income. You can do something outside the box, not just straight line loan terms against the asset.